What's going on YouTube? Mark Fleetwood here. Welcome back to the Daily Grind Trader. Today's video, I'm going to go a full 100% start to finish breakdown of a trade I just took on Bitcoin. I don't mean just as in this moment, hours ago, earlier today, and actually will be yesterday by the time this video gets out. But I want to show you step by step how I break it down and how I can potentially, if this trade does hit for me, potentially get a better than 20-to-1 reward to risk ratio on a single trade. And this is on Bitcoin, and I'm actually going to go short. I'm going to show you exactly why I'm going short on this trade. Start on the weekly time frame, start micro, top down approach. We're going to start on the weekly time frame, and the first thing I'm looking at is I'm seeing that we had relatively equal highs. So here, tested it again, and then we broke through that high. We broke through the high with some displacement. That was a pretty strong move. It was a 15% candle. There are two reasons why, only two reasons why price moves strong to the upside or strong to the downside. It is to either take liquidity or to rebalance the market to find an inefficiency or an imbalance. So what do we have here? Right where price reached to, we have a sell side imbalance with a buy side inefficiency. What does that mean? There is a fair value gap here where the wick of this candle stopped here. Price sold straight down, and the next candle only had a tiny little wick to the upside before selling straight down again. Now, what does that mean? That means that there was an inefficiency here. It was only sell side delivery, only selling down, no buying balance. That was an imbalance, a inefficiency, however you want to call it, but typically it's called, this would be a SIBI, sell side imbalance, buy side inefficiency. If you listen to people talk about the markets, you hear people talk about trading, how it's really hard to trade because the markets are really efficient, right? People say that. I hear it on the news. I hear it on like Moneyline and CNBC or whatever. The markets are really efficient. They're algorithmically controlled to be efficient. Now here there's an inefficiency. What's the market want to do? It wants to make it efficient. It wants to balance it. So what happens here and what happened today? Take this Fibonacci retracement, go from the top to the bottom of that fair value gap. 50% broke the mean threshold. That means that that inefficiency is now made efficient. It got through 50% of it, and now price can come back down. Now you're thinking, hey, we're getting close to the halving, we're getting ready to get a bull run. That's all true, but price will retrace at least one more time, and even in the bull run, price will retrace. There will be 20% retracements, 30% retracements, and then there'll be 60% runs. We know this. We know how crypto works. We know how markets work. Now, what we have here also is we look like we have a market maker model forming, and I'm going to show you the market maker model because we had been on the buy side of the curve. Now we're on the sell side of the curve, where we're approaching the sell side of the curve, and I'm correct. And if I am correct, I will have hit the very mohawk top of this curve. So buying. We have the initial accumulation, and that is here. Relatively equal lows through here. Now we had this dip down here that was taking liquidity. Again, why does price move down strong or move up strong? Is either going to take liquidity or it's going to balance the market. So this was taking liquidity to make the push to the upside to start the buying cycle. Now we have that. Now we have our first reaccumulation phase. Sat here in this reaccumulation, relatively equal lows, relatively equal highs, and now we bought up again. We bought up into this area where we are again balancing the market. Bring it down to the 4-hour time frame. I'm going to zoom in a little bit. Zoom in now. What do we see on the 4-hour time frame? And this is where the trap comes in. This is where people get stuck, and I made a post about this on X. We have what looks like to be a bull flag, bull pennant, whatever you want to call it, breakout. Looks like we have a breakout. Now we've got this whole area here, people going long. I want to make this red because this is a red danger zone, because These are all stuck, trapped traders. Their stop losses are going to get hit, likely right below this low, below this old support, and then we're going to have a cascade to the downside. Because we have, again, remember, balancing the range, balancing the price and efficiencies. We have this large buy candle, wick low here, wick high here, fair value gap. What do we get? We get a selling candle almost equal to it, that rebalanced that range. This is a balanced price range now. No need to trade to it, no need to trade back into it or above it. I don't believe this high will ever get hit. Well, not ever, but in the current cycle, in this current market, current model, this price won't get hit again. And the buyers who are buying that breakout are stuck. They're either gonna get stop lossed, or they're just gonna hope for a break even and just let it ride down. Might get liquidated. But there is the trap, and it's the inducement. It broke that high, induced buyers to get in on a breakout, and they got trapped. Now we go down to the 1 hour. The 1 hour is where I made my entry. So in the 1 hour you see low, high, low, lower high, lower low, lower high. This fair value gap here was my trigger for entry. And my trigger for entry I got entered into the position at right around $35,000 with my stop loss right at $35,500. And what's my target? My target is the bottom of the first accumulation range, or excuse me, the second accumulation range. And honestly, this is not quite drawn up right. It's going to be 24,750-ish. And that is a 20.6 to 1 reward to risk ratio, a 29% drawdown, and that on 20x leverage, because I only have a less than 1.5% stop loss. So I'm making a trade where I'm expecting a 20% drawdown with a stop loss so tight it's a 1.5% stop loss, and I'm not worried about it getting hit. And this relatively equal lows here, right around 7,000 or 24,750. Let's call it 24,800. But these relatively equal lows, with these relatively equal lows, is where I think price is going to come down to, and it's going to get swept, and it's going to be a liquidity sweep, and that's going to get the price to start moving back up. So we're going to have about a 29% drawdown, 30% drawdown, which, if you go back prior to the 2020 halving, prior to 2016, there's always a drawdown before the bull run. It was almost 70% for COVID, and even if you discount that one, you go back to weekly. Let me show you this. Even if you discount the wick down here, right? So say it never went back down to 3,900, but it only went down to here. This was pre-COVID. This was December 2019. From the peak down 54%. And this chart doesn't go back, but 2016 was like 45%. So 50%, 72, but let's say that's a wash. Let's just say that's an anomaly, but 53%. So it is not unreasonable to expect a 30% or 29% come down before the bull market really takes off. Just remember that. I'm not bearish overall on Bitcoin. I'm not an anti-Bitcoin person. I'm reading the charts, I'm seeing the models. This is what's making sense to me. This is what I'm seeing. And on the hourly, I know right now I've got at least one lower high that's already been formed below my stop loss. And that's where my entry was. I got almost the very tip of that second lower high. And I could be wrong. It could bounce back up and take me out. No big deal. I'm out 20% on my trading on my futures account, not a big deal. But if it goes down and it comes down to 24K, 25K, that's a massive, massive comeuppance. So with that, guys, I want to call the video here. Hope you enjoyed. Hope you got something from it. And as always, until next time, peace.